Well, thank you everyone for joining us today to discuss COVID-19, recessions, and its impact on multifamily real estate. It's been a long few weeks. Before, I used to consider myself a homebody, but after spending almost 3 weeks in the house, it's been pretty rough. And I'm pretty sure that a lot of you feel the same way. We're all facing an unprecedented circumstance, and the uncertainty can definitely be overwhelming. There's a lot that we don't know. There's a lot of questions that need to be answered. But what we do know is that at the end of this pandemic, once we overcome, the world is going to be a very different place. This is the reason why we're having a webinar today. We think that right now is a time for you to think about where you'll fit into that new world and where the best opportunities are going to be. Before we get started, we have a few notes from our legal team. You always need a good lawyer to spoil the party. But it's important to note that we're not acting as investment advisors or in any advisory capacity. This webinar is intended to give you an idea of what we see in the market. But at the end of the day, you need to do your homework and you need to work with your advisory team, your legal team, to determine your own risk tolerance and your investment strategy. In many ways, the virus has taken over our lives. So I'm going to purposely avoid rehashing any virus timelines or going through any matters that we're all aware of for our agenda. But what I do want to discuss is the COVID-19 peak and the government's economic response to the crisis, as well as the overall economic outlook. Then we'll jump into some specifics on multifamily and why we think the space will present some strong opportunities in the coming quarters. As we go through the webinar, any questions that come to mind, please type them into the chat box. And we're going to save some time at the end of this to go through all of your questions. A bit about myself. My name is Chris Chambers. I've been in the world of real estate for almost 20 years, starting out like most. Once I left college, I started purchasing single family homes and renting them out. And then I eventually graduated to larger properties in the multifamily and hospitality space. I'm currently the Chief Financial Officer for Platinum Premier Global Equity, where I live and breathe the stock market and real estate markets. I'm mainly focused on making sure we find the right projects in the right markets and that we put together a business plan that we can effectively execute on by asset. Now, Platinum Premier Global Equity is the formal name of our company, but everyone affectionately calls us PPGE. We are a global real estate private equity firm that helps our partners across the globe protect and grow their wealth through real estate. Now, our team is made up of quite a diverse range of individuals. We have CPAs, financial advisors, fund managers, bankers, physicians, and educators. And this helps us bring a diversity of thought and fresh perspectives to the table whenever we're analyzing different deals and opportunities that come up in the market. Because of the international nature of our business, we've been tracking the virus since probably late December, early January. And many of our clients, particularly the ones in Singapore, were sending us some alarming messages about how fast the virus was moving and how disruptive it was becoming to their lives and the health in their country. And now that the virus has made its way to American shores, we're facing a lot of the same alarms. And we're certainly asking ourselves a lot of the same questions that they asked. The most important of which, the one that's on everyone's mind, is who took the toilet paper? Where did all the toilet paper go? But we're also asking, when is all of this going to be over? When can I leave my house? What's the impact going to be on the economy? And how long is it going to take for things to recover? Now, you'll excuse me. Now you'll see these are the forecasted cases of COVID-19 in New York from a company named GMI, and they, like us, they are hopeful that the peak will take place in mid-April, which would possibly mean an additional 6, maybe 8 additional weeks of social distancing and some degree of economic shutdown that we'll have to have here in the United States. It's a pretty scary thought. And I, for one, find myself thinking about the particularly nasty impact that this is going to have on some sectors and areas of our economy, especially the businesses that don't have enough reserves to maintain their staff and keep their doors open. So the government, has great oversight of this. They have released an onslaught of economic boosts in the form of the CARES Act, and the intention here has been to, if I could boil it down, I would say that the government is really trying to get as much cash as possible into the hands of everyday people. In order to do that, they're essentially becoming the payer and the lender of last resort, which is a pretty dramatic change from the typical stance of our administrations. And this chart here really summarizes the CARES Act. It's a very difficult chart to see, and I think it really symbolizes how much is happening in this act. There's so many areas of our economy that are impacted that they've had to really increase the breadth of their rescue. Now, the good news here is that the government has committed to take any and all steps necessary to protect jobs and the economy. But the bad news is that the $2 trillion stimulus may not be enough, and it's more than likely that a fourth and a fifth round might be necessary. We even saw today that they're thinking about extending some portions of the CARES Act, and it's possible that a fourth round is going up to Congress in April. So this is something that might be with us for some time. And even with all the work that they're going to do and all the stimuli that they're going to put forth, it's possible that they're not going to be able to help every area of our economy. And because of this, major players like Goldman are forecasting a negative 24% GDP, negative 24% GDP for the second quarter, which would be the worst GDP on record. Now, the hope is, and this is the good news, the hope is that thereafter we'll have some form of a rapid recovery, whether it be a V shape or a U shaped recovery. And that's good news for all of us, right? Eventually we'll get back to where we were before and even surpass it, but it's going to take some time. So that's the backdrop that we're working with right now. But the important question is, what does this mean for you? First, you need to make sure that you're prepared, you and your family are prepared financially and health-wise. It's a great time to revisit your budget, make any adjustments, and make sure you have enough emergency cash set aside in the event of the worst case scenario. It's also a good time to assess and prepare any dry powder. Dry powder being any capital that you can use for investments. This is a really great time to assess your overall picture, your goals, and begin thinking about opportunities for capital deployment in the near future. We all know that these downslides tend to be temporary, and these create opportunities that people who are willing to take advantage of can really prosper. PPGE, my company, we've done our own assessment, and we looked at the world, we looked at our goals, and looked at various sectors, and it has led us to believe that some very special opportunities are going to open up in the world of real estate, particularly in the multifamily segment during the third and fourth quarter of this year. Now, we know that multifamily is going to be impacted over the next 2 months. I'm sure that everyone on this call knows somebody who is in some financial distress, might not be able to make their rent over the next month or two. And of course, that impact is going to create some stigma around the industry and around property ownership. But these impacts are going to be temporary. And because of this stigma, they're going to create some great buying opportunities for long-term investors. If you take a step back and think about the virus itself, as bad as it is, it doesn't change any of the long-term demand fundamentals driving multifamily real estate. Many in the news are painting a very bleak picture across the industry, and the broader market is going along with it. And typically that creates the greatest opportunities to prosper. And one of the reasons that is that property and multifamily specifically is very unique. See, the demand and the desire for housing doesn't change. Everyone needs safe, affordable shelter. It's a very basic human need. I bring your attention to Maslow's hierarchy of needs. In the 1950s, there was a psychologist, his name was Abraham Maslow, and he studied the positive human qualities and what made successful people successful. And what he discovered was that at the very foundation of human needs is food, water, safety, health, and of course, shelter, housing, multifamily, a residence. So no matter the condition of the economy, people at their foundation are always going to need good, affordable, safe places to live. And this is one of the reasons why multifamily tends to weather every economic down cycle and come back even stronger. Now, that's not to say that multifamily isn't impacted during a recession. We spoke about some people not paying their rents for 1 or 2 months. This recession is quite unique because there's almost nowhere to hide. Every industry is being impacted here. But for the multifamily industry, we expect the overall impact to be minimal and very short-lived. And you can see that's exactly what happened in 2008 and 2001. 2001 was, in fact, a very unique recession because it was driven by housing. And even then, multifamily made a very quick turnaround, just like it did in 2001. So we think that the current recession that we're going through is going to present some opportunities for you to buy the dip in multifamily. Multifamily dips, but when it dips, the dips don't last long. During 2008, the dip only lasted for 5 months. You can compare that against other sectors like industrial or office, where industrial, the negative trend was for 13 months, and in office, it was 9 months. Multifamily was only 5 months. Now, most of us are familiar with the tax benefits that come along with real estate. And all of us like the healthy cash flow that it produces, especially the consistency of it. Mailbox money is what people usually relate to multifamily real estate. But there are other positive characteristics of multifamily that you should also consider. The first of which is that it's in very high demand. And this is largely due to the changing demographics of America. America is very different than it was before, and people's behaviors have changed. Multifamily is also highly localized. And so it allows for investors to benefit from information asymmetry, right? So what does that mean? It means, to give you an example, consider your own neighborhood, right? You have some very unique information about your neighborhood that outsiders don't. You know what happens when it rains, where the water builds up, right? Little details like that that an outsider would not know. In the stock market, this would be considered insider trading. In the world of real estate, this is a great benefit to you. Also, with multifamily properties, you have direct control over the asset. You can determine when you make additions, what amenities you add onto your property. You determine when you create the value and how you price that out. And so you have a very significant control over your asset. Also, multifamily, it's a long-term lease structure. And so this allows you to weather a lot of storms. You don't have a 1 or 2 month contract, you have a 12-month contract with your tenants. And it also allows you to capitalize during boom times where you can take advantage of the increasing rents. So a lot of flexibility comes into play with the asset class. You know, one of my favorite things about real estate, being a risk manager and quite conservative in how I look at the world, multifamily allows you to spread your risk. Let me give you a quick example. If I'm an owner and I own a 100-unit property, if the economy hits the worst case scenario and 30% of my tenants stop paying, I still have 70 paying tenants. So as long as I build my pro forma and build my business around these scenarios, I'm still going to be fine. And that's what I love about multifamily, a lot of flexibility. And I also love the breadth of information that's available on in the asset class. You have a great sense of how it performs at its best and its worst. And historically, multifamily has had very low vacancy and low default rates. This is going back 40 years. But an even more important characteristic that I'm seeing are the demographic shifts that have taken place in America over the last decade. And we're going to go through 3 of the long-term demographic shifts that I have been tracking that we look at and we use in our investment models. And these demographic shifts are very significant because they're not going to change with this current pandemic that we're facing. Once we come onto the other end of it, these demographic drivers are still going to continue. And the first of which is the millennial shift. Everyone has something to say about the millennials, and it's usually not positive. But whether you like it or not, the millennial generation has changed the way we live, and they've fundamentally changed the rental market. First off, millennials are delaying marriage and childbirth. They have put us all on notice that the American dream in their eyes is dead. And that's significant. They don't want 2.3 kids. They don't want the picket fence, and they don't want the house in the suburbs, at least while they're young, not while they're still young anyway, right? What they want is to be able to walk out their house, walk down a block to Starbucks, get their chai latte, walk to work, and be able to travel the world. This is very different than what we saw in the 80s, where the average age of getting married for your first marriage, at least for a male, was 24. For a female, was 21. Today, the average age of getting married is 30. So you think about that gap between 24 and 30, you have 6 additional years that a large portion of our population is going to continue renting. And that's a major demographic shift. Okay, that means that those individuals are no longer going out to the burbs and buying a house at 25. They're completely comfortable with paying $2,000 a month in rent and having access to everything in the big city. This equates to that demand change that I was referring to, right? This is a long-term structural change in the rental market and rental market demand that didn't exist over the last 60 to 70 years. Think about your own family members, the younger ones, and how they're perceiving in their lifestyles. Are they going out and purchasing homes as soon as they get out of college? They're probably not, for different reasons, but most of it is lifestyle. And we're seeing a very similar preference shift amongst baby boomers. The baby boomer generation is the largest living generation of Americans. They're still very scarred from the 2008 global financial crisis. And because of that, there's been a major shift in their thinking. Instead of selling their home up north and buying a retirement home in the South, many of them instead are taking that nest egg and becoming long-term, if not permanent renters. And it's hard to blame them, right? They can move into a rental community, they'll have a pool, they'll have new friends, community events, and they'll have no maintenance burdens as they age. So they can just call up the maintenance person. And so that group is now adding to the renter pool. And when I look at our economy and where we are today and where we're going, I see that as another trend that's going to continue. Retirees are going to continue to face cash constraints, and as that demographic ages, renting is going to become a much more viable option for a larger segment of that population. Now, the third long-term demographic shift that we are seeing in America is the rate of home ownership. And this is very significant. Again, I mentioned the American dream. The American dream was always to get a home and, have kids, get married. At its peak, pre-global financial crisis, home ownership rates were close to 70%. Today, they're closer to 65% and even lower in the most desirable big cities in America. And that's a significant drop, 5% in the demographic. And there's several reasons for this. I mentioned two of them. You have the millennial shift, and you have a lot of baby boomers that aren't repurchasing new homes. But you also have lenders that are taking up different lending practices and being much more conservative with their lending. So you have a large portion of our population that just won't qualify for a mortgage. But you also have a major change in home ownership because of affordability. It's become very difficult for the average American to afford a home. And the reason for this is that home prices are rising so much faster than our incomes. I live in Tampa, Florida, and let me give you an example from my own backyard. Over the last 20 years, median incomes in Tampa have risen 46%. So that's roughly 2 to 2.5% per year. During that same period of time, home prices have increased 190%. That's a significant difference. That means a larger down payment takes you a lot longer to get into a home. And you're seeing the same things across the country. I'll give you another example. Austin, very popular destination, really cool city. I love it. Median incomes have risen 58%, largely driven by tech jobs. But during that period of time, home prices have risen 175%. So incomes can't keep up with the housing prices. And so therefore, it's much harder for the average American to afford a home. Therefore, you become a long-term renter. And so these three trends combined with the positive characteristics of multifamily have created a long-term structural change in the demand for rental units that we just haven't met yet. And it's part of the reason that when you travel or even in your own community, you'll see at least probably one, probably several. I know in my community, it's several properties that are being built. And that's because it's very hard for our communities to keep up with our housing needs. And, if we look at the pace of these demand generators, millennials, baby boomers, and affordability of homes, it may slow for 2 months as we go through this crisis, but it's going to come roaring back because those fundamentals are still going to be there. It's even possible that it could be more exacerbated. And so because of this, my company, PPGE, we're specifically looking at opportunities in strong markets for value-add multifamily that we can ride the recovery wave in. And that recovery wave is going to come in, whether it's in the form of a V or a U, eventually we are going to experience a recovery. And so we're positioning ourselves in multifamily to take advantage of that. And so I've shared a few things and I have a few questions in the chat. So what I'll do now is I'll pause here and I'll open up and respond to a couple of the questions that have been sent to me. And you can go ahead and add any additional questions that you have. Now, the first question is, real estate may do well, but won't the stock market do better if the economy rebounds? I think this is a great question. The stock market has been hard hit. And, when I look at multifamily, I don't look at multifamilies versus stock. It's not really an apples to apples comparison. I look at it as apples and apples. You go into the grocery store and you're getting an assortment of fruits and vegetables. You have to fill it up. And I really like that approach. This multifamily allows you to diversify your overall asset base and allows you to take advantage of the pros and cons of the stock market as well as the pros and cons of multifamily. So it is possible that multifamily over the next few years could certainly outperform the stock market, but that's hard to say. What I like to see is that multifamily really complements your overall stock portfolio, and you should really explore allocating a portion of your investments to the multifamily space. So really appreciate that question. Next question is, do you think there's a risk of governments implementing rent control that can hurt landlords? Very interesting. There's a wave across America where a lot of governments are trying to find a solution to affordable housing. Housing is getting very expensive, even the rental space. And the reason for this is that America is a bit behind on some of our housing development in areas that people want to live. And typically, people want to live in places where there are jobs. So these job centers just don't have enough housing. And because of that, being in a free market, rent prices go up. And a lot of cities are implementing rent control. And there are a lot of mixed feelings on it. Statistics show that rent control can have mixed benefits. A lot of times, unless the government partners with developers and landowners, affordable housing at a rent control price doesn't get built. But when you think about an investment strategy, overall, it's probably in your best interest to not invite that much risk into your strategies. For my company, when we look at our overall business and our approach, we try to avoid any cities or areas where we think that rent control can be a major risk. And right now, until we find a better solution long term, it's probably better for us to avoid that, because you really can't control that, and it's a huge unknown, and it doesn't benefit the strategies that renters or landlords want in the long run. Next question is, outside of Texas and Florida, what other states do you believe will do the best to invest in multifamily housing? I love this question. It's really asking, where are the best multifamily plays? And when I think about multifamily is all about people. People, and what drives people is employment. So when we're asking where are the best places for multifamily, well, we're really asking is, where are the jobs going to be in the future? And right now, for our economy, we're a bit more of a service-based economy. And so the service-based jobs are really being created in technology for the most part. And I still like markets like Seattle. We have a couple of projects there. Texas is great. Different parts of Florida is great. Florida is a great market. And the reason is because you have 1,000 people moving into Florida a day in a very constrained landmass. And a lot of them are boomers, and some of them are millennials moving down for a better lifestyle. I like markets like North Carolina because those cities have done a great job with attracting employers. At the end of the day, real estate is very much a public good in some ways, right? You need to be in partnership with the government. So when we invest at PPGE, we're looking at, okay, what's this city's long-term plan? We don't want to invest in a city for 1 year, for 2 years. We want to be there for 10 years, 20 years. That's how we look at all of our relationships. And so we'll go in and we'll look at what the city plan is and how are they going about attracting new employers. And those employers we know are going to bring people to work. And if they're paying a good, reasonable living wage that people can truly survive on, you're going to have a thriving multifamily market. So next question is, are there urban areas that oversaturate the market? Would they be good investment opportunities, or would you look for other markets? So good question here. This is really about supply and demand. And, real estate has had a lot of development. And the great thing about that development is that over at least the last 4 or 5 years, the rate of new apartments being rented is above the rate of new construction. So that means that more people are renting than units are being built. So that's good. But there are a lot of markets that are probably being a bit overbuilt. I had some concerns with the New York market for a part of the year, and so that was a concern of mine. There are some sub-markets that are also being overbuilt, and so when big picture, when I look at individual markets across the U.S., I do try to stay, if we're not doing something that's development based, I do try to stay away from markets that have too much new coming in. And the reason is because new supply just floods the market. It's very hard to compete that way. What we prefer to do is to look at properties that we can improve, create value for the ownership, and create value for the neighborhood. That means that we'd much rather purchase an asset that already exists, purchase a multifamily building that's already there, and make some improvements, increase the quality of life for the tenants, and maybe we'll charge, a couple of dollars extra in rent that will compensate us for making those investments. And so, there are certainly opportunities in some of those markets, but I'm very wary of any market that has too much supply coming in. Okay. And so next question is, would it be wiser to invest in commercial lease space as opposed to multifamily, as being a residential landlord can be demanding with maintenance, etc., evictions and repairs? Great question. Two very distinct markets, and I think it really depends on what we're seeing in terms of dynamics in very specific communities. So it's hard to answer. It really depends on the location. Now, across the United States, what we saw over the last maybe 30 years is that in the 80s, a lot of office space was built in America, a tremendous amount of office space. And so it's really taken the market another 30 years to absorb those units, to get those fully tenanted. And so when you look at the commercial space for office, the average vacancy rate is about 20%. And even in those areas, when you're running an office, you still have the same issues, right? You still have to do maintenance, you still have to do evictions, you still have to do repairs. We like multifamily for several reasons. Typically when we purchase multifamily, we're going to go in and partner with the right property management company, right? Because our expertise is not in managing the property, it's not in signing leases, right? We'll partner and we'll pay 3% of rent as part of our income statement to the right property management company who can get the job done and get it done well. Outside of that, we look at multifamily because it's much more protected on the downside when there's a recession, and we can really work around some of those additions. So for instance, for multifamily, I know I can go in and find a good property in a very, very strong neighborhood, make some additions. Maybe you go in and you change the kitchen, you change the flooring, very basic things, and renters are willing to pay a few extra dollars to have that higher quality of life. And so my investment turns into an immediate return, which makes me desire to do even more for my tenants. And so that's why we like the multifamily space. Office has many opportunities. Seattle, again, is a great market for office. North Carolina is going to be one. But you have to really pick out some parts of Texas are as well. But you just have to really pick out the market and look at it. But I think the two sectors have some very distinct dynamics, and we prefer multifamily because of the characteristics of the segment. Now, Rob is asking, what is the ideal number of units that you look at? For us, we like units that are anywhere between 50 to 150 units would be a sweet spot. And there are two reasons for that. The reason for the low end is that most strong world-class property management companies are not going to manage properties below 50 units. Okay. There are tremendous, fantastic opportunities below 50 units. We're exploring them and figuring out how to do them on scale, right? Part of what you need to do is that you have to have a good property management company. So you have to build out the right team. So great opportunities there. But in terms of ideal, 50 to 150. I don't like to go over 150 or 100 units because at that point in time, you start to compete with a lot of the life insurance companies. You start to compete with a lot of the large money players. And it's always a good idea to stay away from folks who have a much bigger bankroll than you and can really push you out on price. And so you'll end up losing a lot of deals. Between that 150 to 100, 150 space range, there are fewer players, and we're able to execute on our business plan much easier. And it's a space that we're comfortable with. I do like some smaller plays that I'm entertaining right now. And so my response to that might shift down a bit to maybe 40 units or 35, but 50 to 100 units, 150 units is a really sweet spot for us. Again, really, really thank you guys for all these questions. See, I have a couple more coming in. So the question is, many people are now working from home due to COVID-19, and will this have an adverse impact on office rental space? It's 50-50, and I think it's yet to be seen. We don't really know. I think this, for some employers, this will be an excuse for them to accelerate their work from home plans, and they will reduce their office expense budgets. That's very possible. But I think it's also going to be the opposite for some. Some employers are going to find it very difficult to work from a distance. They're going to find that they have the best synergies when people are in the office together and collaborating. And so it's going to be very interesting to see how it plays out. I think we're going to fall out somewhere in the middle where it's going to be much more acceptable for people to work from home. What I see happening is that a lot of people are going to be very interested in having maybe a satellite office for their employer, because the fact is that working from home is not easy, especially if you have children or there are distractions in your house. Maybe you're taking care of your elderly your parents. Working from home presents a lot of distractions. Being at home is a whole nother job. And a lot of people need to get out of that and need to get into a different routine in order to be successful in their job. So I think it's going to be interesting to see how it plays out. I think there will be some impact to some markets, but I think it's going to be less than a lot of people are expecting. Okay, I have another question here. And the question is, how long do you think that these these demographic trends will last? Now, I've done some studies on this. The question is, for millennials, for baby boomers, how long is the trend of them desiring to rent going to last? And it's very interesting. If you look at generations and demographics in America, it's very hard to change a demographic mindset of a certain generation. I'll give you an example. Folks who lived through the Great Depression are not going to change their saver mentality. It's so deeply entrenched in their mindset that it's just a part of their generation. It's who they are. Baby boomers are what baby boomers are. It's very hard to change a demographic mindset. And so when I look at these trends, I think these trends are going to continue for at least the next about 20 years. We'll have about to 2040. And we ran some numbers on this, looking at what the rate of rental for millennials are. We know that when millennials get to about late 30s, at that point in time, they start to have children, they start to move to the suburbs, so you lose some of those renters. But to replace them, you have the generation coming up right behind them. And that generation is even more predisposed towards renting than the millennials. In fact, a millennial might be totally comfortable in a 500 or 800 unit square foot apartment. The generation behind them, the folks who are 20, 21, 22, 23 right now, those guys are living in 200 square foot apartments in the prime neighborhoods in prime cities and sharing living spaces. They're sharing kitchens. In some cases, they're sharing bathrooms. So it's almost like a dormitory. And so their mindset's completely different. They say, hey, I want to live in a prime area. I don't need that much space. I'm going to lower my overall rent, and I'm going to use the rest of my money to do other things, whether it's travel, whether it's start my own business. And so I don't see that these trends changing anytime soon. I think we have about a solid 20 to 25 more years of the rental demand continuing to increase. Next question is, I like multifamily, but it's too expensive to buy one of my own. Realistically, how can I get started? People who are interested in multifamily, there's a lot of ways to do it. You can partner with family and friends, other individuals that you know. For us, PPGE, we're syndicators, so we take our own capital and we partner with other individuals who and we find the asset for them. We manage the asset, we collect the rents, we handle everything from top to bottom, and so they don't really have to worry about anything related to the answer, um, anything related to the asset itself. And so it makes it a lot easier, right? They can spread their risk. They don't have to go all in and purchase, $1 million property all cash. If they can, that's great. You know, should certainly pursue that. But if somebody's looking to make, several small bets and diversify their overall portfolio, for us, we typically will do, $25,000, $50,000 per partner coming in. We'll pool our own assets with it, and we'll go out, do all the due diligence, work with the team, assemble the right people coming in, and make the asset work for them. So I think that's one of the best ways. Another option is to look at REITs. I like REITs. I don't like REITs sometimes. And the reason I don't like it is because they're very highly correlated to the stock market. There was a time this was not the case. When they were first developed, really by Sam Zell and right after the GFC, in fact, they weren't as correlated. In fact, they were negatively correlated to the stock market. Now, because so many ETFs have REITs, and because real estate's now officially a part of an officially recognized sector of the stock market, there's a much greater allocation into these real estate REITs. And because of that, when the stock market goes down, REITs go right down with them. And we like to use real estate as an offset and as a diversification piece. And when you have such a high correlation, it's hard to achieve that, even though you have some other benefits. I have another question here. Let's read through it. All right, so the question is, considering the USA's GDP of 70% consumer spending, which means, our GDP overall consists of businesses spending, consumer spending, and government spending. America is a consumer-based society, and so 70% of our GDP is based on consumer spending. And the question is, when should you expect GDP to decrease by more than 24%, which will ultimately affect rent or mortgage payments? The answer here is that we really don't know. I've seen very wide ranges on where our GDP is going to end up. I've seen everything from second quarter being positive 2% to all the way down to about 20% GDP erosion for the second quarter. I think the big picture here, though, is that we don't quite know what the second quarter impact is going to be, but we know the second quarter is going to be very ugly. But after that, we're going to recover. And the reason that we'll recover is because, right now we're essentially at war, and we're at war with a silent enemy in the form of a virus. And we eventually are going to defeat it. And at that point in time, once we get people back to work, and once we, get the economy moving again, we should be able to accelerate back up to where we were before. And why do we accelerate? Because there's a tremendous amount of pent-up demand. You have inventories that haven't been ordered that are going to be ordered. You have a lot of people, for instance, my family, right? My wife and I were supposed to have a baby shower. We're expecting a baby. We didn't get to do that. And so that's spending that we're going to do once, we're allowed to interact with other people and have events. And a lot of people are going to be in that situation. Now, there's going to be a segment of our society that is really, and it's going to be very broad, that is going to be impacted and suffer. But I think that impact is going to be very short term. And if you're an economic buff, you can compare this to the recession that America went through in 1920, and really look at how we reacted to that. It's not really the same example. A lot of different factors play in there, but it was a very deep recession and very, very quick. It only lasted a couple of months, and America was able to accelerate back through it. And so we've had a lot of situations like that. So I do think that we will have some pain going in through, but I don't think the pain is going to be evenly spread in our society, which is really unfortunate. And I do think that we will get back to normal, especially with a lot of the support that the government has shown and willingness to make sure that they support Americans and some of their payments. So really great question. I love economic questions, and I spent a lot of time recently studying debt cycles because that's a concern of mine, and really looking at how that plays into real estate and the long-term viability of our stance as a leading economy in the world. And so, I feel good about where we are short and medium term for sure. Okay. Now, field any last questions that anyone has. I think I've caught all the questions. That I'll just go ahead and double check here. All right. Awesome. Well, hey guys, thanks again for, all of your time, all of your questions, and for allowing us to share our passion for multifamily. We spent a lot of time trying to figure out where we think that people should be. If you have any questions, any debates that you want to get into, anything of that nature, any information that you need, please reach out to us. Our contact information should be on your screen. And again, we thank you and hope that you and your family stay safe and really use this time for good opportunities to love on each other, and eventually we're going to get through it. So thank you everybody for your time, and we'll be speaking with you soon.